Welcome to this Bennett Explains Finance video. In this week's video, Black Monday, 3 investing lessons. Now the dust has well and truly settled on Black Monday, so what as an investor can you take away? It's important to learn from events like that, so what can we learn? Well, first of all, what was Black Monday? It was the 24th of August, a date etched in many investors' minds now, assuming they weren't on holiday. What happened? Well, I've just picked one market here, the Dow Jones, one of the main American indices, plunged 1,000 points at the open. It's never fallen that fast in a single day, and eventually closed at the end of the day 600 points down. And that kind of drop was mirrored across major indices around the world. The trigger, no one's actually 100% sure, but likely to be China. The Shanghai Composite dropped just before that, 8.5%. It looked like Beijing couldn't actually control the speed with which Chinese stocks were falling. People began to ask questions about how strong the underlying Chinese economy actually might be, and a degree of panic set in. Typical headlines: as stock markets crashed, is the world facing another financial crisis? All right, now, as an investor, what do you take away from all this? And I'm going to suggest it's 3 things. First of all, stock prices in the short term do correct, and sometimes they correct heavily. Doesn't matter, provided you don't take the wrong approach. You don't panic sell, and you don't put yourself in the position of having to sell during one of those corrections. Number 2, sometimes you need to look through the stock market. So if you're a UK investor over the long term, look at what's happening on the ground. Really, is the UK economy in the state that the stock market suggested it must be in on that one day? No. Number 3, the market's best days often follow its worst. So it's kind of a double whammy. If you bail out while the market's going down and then fail to get back in again, you can miss out on some of the best gains, and that can seriously restrict your long-term returns. So, taking those in turn, there are pretty sizable dips en route from the 1970s to getting up to more like where we are today. So the trend, although the past is no guide to the future, is reasonably obvious. But look at some of these big dips. Reasonably recently, we've had stock market dips, this is the FTSE All-Share, of more than 50%. There's one. I mean, this makes Black Monday look relatively small fry by comparison. There's another one, 50% dip, now admittedly over more than one day. Then if we go back to just this handful of years here, there's a 2/3 drop in the stock market. But the overall message has to be that provided you don't do the wrong thing, provided you hang on in there, provided you put yourself in a position where you can ride out these market cycles, they don't have to damage your long-term returns from stocks. Now, the reason I think why more people panic when things like Black Monday happen than probably should do is complacency. People forget that over the short term the stock market can be volatile. And here's an illustration of what I mean by that. Here's the Dow Jones. Let's go from about 2011. Okay, here's the Dow Jones coasting on a sort of upward path, and set against it, there's what's sometimes called the stock market's fear gauge going in the opposite direction. The CBOE VIX, to give it its full title, is an index built around what options traders in America think. I've done a whole video on that, so I won't say any more. And essentially, the lower that is, the more complacent or relaxed the stock market is in investing terms. You want to see it that way. And clearly, we had a phase here where investors were getting more and more relaxed. Hey, this stock market investing thing is not as difficult as it's made out to be. The Dow Jones was steadily rising, and then bang, there's Black Monday, and bang, there's the other side of Black Monday. All right, now, sometimes I think people overreact to these short-term events because of that complacency that's built up ahead of them. So just watch that. You've got to be ready for the fact that stock markets do correct, and sometimes they correct pretty sizably. Now, looking under the bonnet, this is point 2. Is Black Monday reflective of what's going on in the UK economy? Now, people will debate this, and some people will say, you're wrong, Tim, but actually, fundamentally, I don't think I am. What are we seeing if we look under the bonnet? In other words, take the sort of medium to longer term view of what's happening in the UK. Well, around the time that Black Monday happened, you've got growing GDP, some headwinds overseas for sure, China and so on, but retail sales strong, unemployment low, consumer confidence high, service sector growing. So if you were to read across and say, the FTSE 100 took a beating on Black Monday, is that representative of what's going on in the UK economy? Well, the FTSE 100 is more representative of what's going on in the global economy. There are companies in there with huge overseas earnings streams directly exposed to emerging markets in China, for example. So you've got to factor that into account. It's also, as an index, reflective of just a handful of sectors in reality. Whereas looking at a broader picture, all right, I don't see a Black Monday for the UK economy sitting right there at the same time as the stock market seemed to think there was one. Now, just to take that on, at the time this video was shot, were there any clues as we headed into Black Monday that was going to happen from, say, GDP data? Definitely not, quite the reverse. That's a measure of sort of the growing wealth of the economy. And you can look at one of those other measures. I won't do all of them. You could take, say, retail sales. Yeah, there's the retail sales number. There's Black Monday. All right, so the question is, which one do you believe? And people say, well, the stock market is forward-looking. But actually, what happened in the subsequent days to correct some of that Black Monday drop suggests that actually the stock market overcooked the correction, especially in terms of what was happening in the underlying UK economy. So, panic rarely pays is point number 3. Now, this is just to make a point about stock market corrections. They usually overdo it in both directions. So on the downside, you usually get too many pessimists. On the upside, sometimes too many optimists. And the reason why panic rarely pays, the reason why bailing out on, say, a Black Monday can be a terrible idea as a long-term investor, is that generally as gloom sets in across the stock market, corrections become, to some extent, self-fulfilling. And actually, as Warren Buffett once said, you don't want to be fearful when everyone else is fearful, you should be greedy instead. And here's the reason, if you like, here's a statistic which I've quoted before on why that's the case. We tend to be fearful at the same time as everyone else because we tend to like to follow the crowd. We don't like to be left on the sidelines. We get out of the market and then we stay out. And the danger of doing that is that you tend to get some of the best investing days right after some of the worst. And Black Monday was no exception. Okay, so the stock market didn't correct all the way back up, but it corrected upwards fairly sharply. And the effect of missing those days, as JP Morgan have shown in a quite well publicised study, if you'd missed the 10 best investing days over a period between 1993 and 2013, you'd have halved your annualized returns just by missing those 10 best days from the S&P 500. And you won't be surprised to find out that those days followed some pretty terrible dips. And that tends to be the way stock markets work. And by the way, we're talking about an annualized return of 9.2 becoming more like 5.4. If you miss the best 50 days over that period, that goes negative by about 4 or 5%. Okay, so Black Monday, a little way off now, could happen again, but let's learn some lessons from it. There are 3. Any questions? Or if you don't fully agree with any of the points I've made, do feel free to email to the usual place.